Okay, everyone, welcome tonight for our Fund of Funds webinar. I'm Adam Lundy with Happy Camper Capital, one of the managing partners of Happy Camper. Pleased to bring you tonight our next installment of the Happy Camper University educational series. We strive to bring our partners, our investors, our friends with great, useful content that will help them in their wealth building journey. Tonight, I'm excited to bring you guys a guest who I've connected with actually through one of his colleagues, who they run the fund school together, help people form funds and fund-to-fund models. So Ryan Yates, who's joining us from New Jersey tonight, is on. So I'm going to open the floor up to Ryan here in a minute. Just as an order of housekeeping as you come in, if you could please mute your mic. That way we just aren't getting distracted by dogs and kids and stuff in the background, and all things that can happen. And if any questions you have that come up, any thoughts you have that you want to share, if you can put those in the chat, we're going to leave a little bit of time at the end to address all of those once we get rolling. So Ryan, welcome to the show. How are you doing today?
Thanks for having me, Adam. Doing pretty well. Thank everyone for joining and signing up for this. Looking forward to it. Just to give you a background on myself before we dive into the Fund of Funds. I've spent about 16 years in the alternative space, working on everything from hedge funds, private equity, real estate, crypto, back office, front office, investor servicing, basically the whole operations end. Outside of that, I am the managing director at Cardinal Financial Consulting and co-founder of the Fund School. Just to give you a little bit of background so you can trust me. So here we are to go over kind of what the fund-to-fund model is and what we can take from it to help investors out. And the major aspect of it is to pool capital. So if you have 6 to 10 friends who have $100,000 each, what's the easiest way to do it is create a fund of funds. And what benefits do they give us? They give us the ability to allocate to different deals. Whereas if you had $100,000 to begin with and you invested in one of the Happy Camper Capital offerings, you would waste your $100,000. Not really waste it, but if you pool up and say you have $1 million and you can separate it across 10 deals, you're diversifying, your friends are diversifying, and you're kind of hedging your risk on that. And the question is, how do we kind of set it up? So it is as simple as creating an entity, getting the documents written up, and opening the bank accounts and deploying. It sounds a lot simpler than it is because, as we all know, lawyers are a necessary evil, and it could take anywhere from 4 to 6 weeks to kind of launch if you're starting in the simplest form. It does go a little more in depth than that, and I'll get into those parts later. But right now, we have kind of 2 entities that we can create. If you guys are all accredited, you could go for the 506C. You guys just kind of create your own capital, keep it all in one fund and invest, or you can go 506B. So the difference between the two really is the ability to go out and market and the ability to let non-accredited investors in. And I know that Happy Camper Capital and the Fund School are focused on creating opportunities. The biggest opportunity is with the 35 non-accredited investors is if you have a pool of capital, say you have 20 friends that are all accredited, your friends and family can come in. When your friends and family can invest, you can help create their wealth.
Okay. Hey, Ryan, real quick, before we dive too far into the structure, I'm just curious, because I'm a visual thinker, right? And I know there's probably some other people in the room like that too. What exactly does a fund-to-fund structure look like, right? And how does that vary from, say, a traditional fund?
It doesn't vary that much. I mean, the good thing about a fund-to-fund is you can invest in multiple projects, where when you invest in a normal PE fund or a say a hedge fund or something, you're investing in, I mean, it's based on returns and different focuses. So fund of funds allows you, and it might be a little outside the norm, but you have investments in Happy Camper Capital, which I'm going to stumble on the whole time, or maybe you find 2 or 3 other real estate offering firms, and you want to diversify that way. The ability to have one person kind of make that decision or a couple people make that decision is advantageous. It's not all on you. You get multiple aspects and multiple point of views, and you get to kind of create your own due diligence and create your own path. Where if you invest in another firm, and this is, I mean, specifically fund the funds, because you have your investors that it's kind of the main. I mean, you can go bigger, you can go home. I mean, it's really up to you guys how you want to structure everything. But if you're going to invest in a fund of funds with people, you have the ability to help with the decisions, and you can kind of farm out your due diligence or not. It gives you a plethora of options to invest. And that's kind of why the fund of fund model is a little easier than, a regular fund. You're going to most likely have friends and family come in. You can go either way, where you can, let them be a part of the decision or not. It's something you decide early on. And it really is free for you to manage this money in any way possible.
Yeah, so there's a lot of flexibility to it. And
sorry,
I'm gonna mute Kathy here. All right. Sorry about that. So Ryan, yeah, there's a lot of flexibility to structure and the way you want to operate it. From an investor standpoint, what's that experience look like?
If you want to be a completely passive investor, it's pretty straightforward. You can just get a statement at the end of the month or quarter or whatever you guys actually set up. There's some tax advantages to having the fund set up. I mean, I can't get into much because it really depends on your personal investments and your personal, your lifestyle. I mean, like I say, you can own your own company, and sometimes it's a better structure there. Or if you're a full-time employee, it really depends on how it's going to cascade through your taxes at the end of the year.
Yeah, got it. Now, if you're somebody who's looking to create one, I guess maybe the starting point is who should look at creating a fund of funds?
I would say anybody who wants to diversify and leverage the amount of money. It's all about leverage. You can go into crowdfunding and put $10 here and $10 there. I prefer to put a little more money in. And if you're not accredited, a fund of funds can actually get you into different investments. So if you have enough, like I said, with the 506B, you can put the non-accredited investors in there, and you can act as an accredited entity. And that will give you more opportunities out there. Because, I mean, as much as we do, as much as we can between the Fund School and Happy Camper Capital, we kind of, we're open to those experiences. Some of the other firms are not. I mean, it's expensive. You can go crowdfunding, you can go Reg A, you have all these different structures that are out there for everyone to invest, but it really isn't that clear. All the better deals, and as much as everyone wants to say that these, the new deals for non-accredited investors are great, unless it's kind of wrapped up in the 506B, you're kind of thrown to the wolves. I mean, if you saw, I think it was recently that NRIA, it was a real estate firm in New Jersey, got caught. They squandered money. They squandered millions of investors' money. And, that was supposed to be for everyday investors. So like when they used to pump penny stocks back in the day, the same thing's happening now. When you go to these better offerings where they have accredited investors, a lot of those places seem to be a little more in line because they have the compliance there, they have the infrastructure, and that gives you a little more comfort. So, I mean, above all deals should be going through your own due diligence plan or someone else's that's qualified in that area.
Yeah, got it. Now, and just and I apologize for stomping in with some questions, but I just had a couple more, I think, just kind of help kick you off. So if this is something, obviously might be what drew some people here tonight, is this is a structure they're looking at starting. What are some of the background prerequisites somebody should have before getting into this? Education, experience, et cetera.
There really isn't any. Oddly enough, you have to be rich to be an accredited investor, but to invest money, you don't. I mean, there are different caveats. Like if you're going to trade futures, you have to sign up for the CFTC and take FINRA exams. But when you get to real estate, it's kind of like the Wild West. In essence, not 100%, but you can start it with as little as $30,000, really. I mean, you can even get cheaper, but finding a reputable law firm is probably number one on the list. We've worked with Thompson Hine a couple times. They've been great. There's different ones out there, and it depends on where you are and where you're structured. You can set up a fund in any state, but there's rules behind it. So there's blue sky reporting, there's different state statutes and items like that you really have to focus on. So, I've started funds in New Jersey and Delaware. I mean, of course, I think we all know that Delaware, fund structure. And the odd part is it's popular because someone started that years ago, and now everybody references Delaware with funds. So that's how it became popular, and it just kind of cascaded from there. And almost every fund you see started was in Delaware, just like the offshore funds used to be in Cayman, Bahamas, BVI, all those different locations. Getting that fund structure set up and getting your documents, which usually is, for the bigger ones, you need a PPM, which is a private placement memorandum, which kind of gives you the focus of what the fund is going to do. If it's friends and family, you don't have to go that far. If it's a small group that you are pooling with your buddies, you just need a limited partnership agreement and kind of set up the behind the scenes structures. There's a bunch of structures that you can use. And currently at the fund school, we set up 3 different entities, but we're also in it to teach everyone from, soup to nuts, exactly what goes through the process from creating the management company. Because if you run a fund of funds separately, the management company handles all the transactions. The fund runs itself, kind of. The management company handles the transactions, and then the general partner, which is the GP, which is usually the person who gets the carry at the end. If you go that far into a structure, they're all segregated, and they're all different agreements. That can run anywhere from 4 to 8 months to set up. But on a smaller side, you're looking at just creating a limited partnership agreement. It's more of a trust thing, especially if you're going with your friends or family or coworkers.
Yeah. You mentioned there are 3 different structures. Can you elaborate?
So, I mean, the 3 structures that I kind of lead towards are, when you go with your friends and family, you can not cut corners, but you don't need anything. You don't need all those, you don't need a compliance team. You don't even really, I mean, you should. I'm an accountant, and I will say this till the day I die. You need someone to handle the books and records, and you want someone with a slightly independent view. The second one would be, creating a management company and running other people's money. When you run other people's money, it does get a lot more complicated. And if it's outside of, your friends and family, things like that, there's rules. And there's rules about raising, and that's where the 506B with the non-accredited investors, or 506C, where you're accredited but could advertise, that opens up a whole new level. And that's where kind of the fund school would come in, if anybody was interested in that, because the fund school will help you set up all your entities, show you how to go out and kind of raise capital and get you in touch with investors. We use broker dealers, things like that, to kind of, drum up interest. You still have to sell. People will be drawn to you because you're in this program. But as these equity guys bring it in, you have to learn to pitch. And that's one of the kind of better parts of the fund school, is it's going to teach you every step of the process, including the process itself. So, when it's yourself, you can run it. There's no need to you got to cross your T's and dot your I's. There's an allocation there. You're not charging any fees because, you're all friends, and you kind of write that in your agreements. And that can easily start in 3 to 6 weeks, probably on the lower end. I mean, if you wanted to, you come in, you talk to a lawyer. It takes a few weeks to draft the documents, make sure everything's in line. Again, you should at least find an accountant to kind of go back and go over everything with you. Maybe a lawyer. Don't go with your first lawyer either. Take a couple chances on it. Because a lawyer is like a doctor. They may be good in their way, but they're all going to come up with different answers. One might like chiropractor better. One might like, surgery. One might just want medicine. It's the same thing with lawyers. You'll get one document that says, maybe management fee should be charged this way, and you get another one with a completely different paragraph on, taking in investments from certain states. It's really going to be kind of what you want your focus to be. Make sure you tell them as specific as possible, and they come out of it. Were you going to say something? I saw you.
No, I'm just nodding and acknowledging. Yeah, apologize for that.
Yeah. I got a question for you. Just is there a certain size limit where it makes sense to do it or not do it? I mean, if you want to create a fund for say like 5 million, is that too little to worth all the hassle and the cost involved, or what's the general range that you suggest people start at?
See, and there's another kind of caveat to this that I didn't think we'd go into, but there is it's called a special product vehicle, an SPV, where if it was probably, I would say around 2 million would be where you'd go for an SPV, and it's fairly cheap. It's a couple $1,000s to kind of spin off. But if you're going to do multiple deals, you kind of want to pull it together and diversify a little more. Like an SPV signs up for one deal specifically. So if Happy Camper Capital has a $3 million raise, you can get 500,000 together. You can invest that 500,000 directly in. And and they're all basically the same structure. You're going to need an allocation. You're going to have to show, pro rata who gets the income versus who doesn't. And then if there's any fees involved, between friends and family, you guys all put in 10,000, you put, the retainer down, and you kind of write it off in expenses when you go to do the allocation. So everyone's in there equally. When you get towards SPVs and fund the funds where you're taking in friends and family, others. So if you have 5 coworkers who come in and you guys don't really trust yourselves, or there's one person who's not going to get along with someone later down the road, you put in expenses and you run them through the fund like that.
Okay. So Ryan, we kind of talked, I asked you, of course, at the beginning, who this might be ideal for, but I guess somebody who's getting started in this, what are the things they need to consider more than just the legal and the setup? Because obviously you hinted to the fact that, like, for example, in the fund school, you teach people how to raise capital. Like, what are the types of commitments we're looking at making when we enter into this business?
I mean, the thing I say for everything is, your effort matters, and how much you put into it is what you'll get out of it. Small side story, I belong to a group called Dad's Night in New Jersey in our town. It helps with 2 schools. The first year, everyone gets up on stage and makes a complete fool of themselves. First year is like, I'm not going to do it. Second year, I go out there, I dress up as Gene Simmons, or no, Paul Stanley. And little by little, I became the treasurer. I was a sports chair. I did all these things, and you really do get what you put into this. And it's the same thing with fund of funds. If you just want to raise cap, or if you have the capital raised and you just kind of want to deploy it and hang out, you can do that. You can do it and probably put 3 to 5 hours a week into it. And then once your deals are out there, you really don't have anything to follow up on but valuations with the third parties and keeping it in line. You don't even need an audit or tax. You'll need tax no matter what, because the US government's going to get their money regardless. Even if it's zero, they still make you go through it, and it'll still cost a couple $1,000s a year. But if you want to start raising outside capital, you're going to put time in. And to put it bluntly, it will cost about 30% of what you raise to raise that capital. And it's a hypothetical number, but if you want to raise $100,000, you're going to put $30,000 at least time into it. I don't know if anybody here has raised capital independently. I've done it a few times, and even just raising it from friends and family gives you a high. But again, it's all up to effort, knowing the rules, and pushing through. Friends and family, like I said, a couple hours to every month or so to kind of keep up on things. As an accountant, I always say keep the books going, and as things come, because once they start building up, you fall behind and it's miserable. But when you start adding outside investors, you have timelines and you have different filings that you have to get to. And that's where compliance comes in and regulation. And then it'll eventually, if you raise outside capital, it could become a full-time job. And that's kind of, that's kind of why we did the fund school and, set it up the way we did. So you kind of know what you're getting into. You can outsource any part of this out too. That's the one good thing about, the fund of funds model and starting to raise outside capital. I do CFO consulting, so it costs a couple $1,000s a month or so for me to come in and review your books and records. There's a company out there called FundViews. They handle the fund accounting from day one. You reach out to them. They have a great connection with a fund admin it's called ESFI out in, it's actually in New Jersey, but I think they have a satellite office in New York as well. And then they have a portal as well. So you have all these things to leverage at your fingertips if you really wanted to go that way. And then you take kind of where you want to focus. The fund school gives you a little bit of each. If you like making deals and you want to look into just do due diligence for Happy Camper Capital, you can do that. If you like the back end of it, you can do it. You can outsource any part along the way. It does get costly. I mean, no one's cheap on this. You're looking at, about 1% of your capital for FundViews to come in. And I mean, obviously, I know we're early on in this, but everyone's charged in the industry is basis points, which is a percentage. It's what 1/100% of a percent. And if you raise $10 million, it's going to cost about 10,000 just to run, that fund for the year. And depending on how much you raise, that's kind of what the expenses. I'm sorry, $100 million fund is $100,000 a year, and that's kind of the cost. But with fund of funds, one good thing you can do is if you want to, you can run all the fund expenses through it. So say you invest 10 million, you make 30 million, you can pull those expenses out along the way. And typically when you get a K1, it comes off the bottom line, and you get to kind of, being an LP in a fund of funds set up correctly, it is advantageous.
Yeah. So Ryan, I guess talk a little bit about, as you're getting into this and wanting to set this up, one of the advantages that you mentioned early on, of course, is diversity. That obviously the advantage for the LP investor coming in is they could get their investment split across multiple asset classes, multiple investment vehicles, multiple operators. For someone getting started in this, how do they is there anything you can share that would help them determine maybe, which asset classes they should focus on, how far they should diversify, right? Is it just, markets? Is it across asset classes? Is it multiple operators? Like what's your general advice on that?
Your text message said just Happy Camper Capital.
That's true. Yeah. Thanks for reading off the script.
No, it really comes down to your personal risk profile. Risk profile is huge. Me personally, I like to be a little risky. I'll reach out into crypto a little bit. I trade stocks occasionally, very few, but I do like real estate. So I do focus towards there. I would say, just to be off the top of my head, from the accountant's aspect of me, I would pick 3 to 4, maybe 5 different managers that you're reaching out to. So 20% Happy Camper Capital, 20% Veloce Capital, 20%, anyone else that's out there, only because you never know what can happen. And, I trust you, Adam, and I would have no problem giving you money. But the question is, can you put all your eggs in one basket? And I think most people could say no. And, to kind of go a little further in that, you look at, people who have 401ks. And there's people who just pile their money into the stock of the company, especially when you work for, say, Morgan Stanley. I mean, I had a great year at Citi back when it went down. Remember in like 2008 when it went down to like $1 a share? I was young and dumb. That was about 15, 14 years ago. So I was in my 20s, I think, maybe 20s. And I was just trading it back and forth. And I ended up making everything back. I started with like 5,000, went up to 35,000. But obviously when you're young and dumb, you can make those mistakes. The older you get, you have to make sure that you have, different risk tolerances. So I don't know about your deals specifically, but if there's, say, a preferred return, that's always helpful. Maybe some pay preferred equity in terms of a coupon every month. I've seen deals where you invest 10,000 and they'll pay you out 1% a month and then true you up at the end when you actually dispose of the actual position. There's so many out there, and the good part is if you get a good group of people who are in the same kind of range as you, maybe age range, maybe kids, who knows what your kind of goal is, it could work out wonderfully for everyone.
So there's some building the investment profile around the avatar of your investor that you're looking to seek.
Exactly. And I think that's even at a personal level. So, I have groups where I invest with other people. We're all kind of focused in the same, vein. And, we also have a couple people that we trust that we let make the decisions. And we know that they have our best interest at heart. And that's kind of when you get into, registered investment advisors and your personal guys, your investment advisors in general, you want them to be on the same page as you.
Yeah, got it. So with the fund school, I guess, talk to us about it. If somebody were coming to you, and I just like to know, could you kind of walk us through the process from soup to nuts on how you come into somebody with a dream and a vision and walk out with somebody who's successfully raising capital and investing in deals?
Well, okay. So, day one, every quarter we're starting to roll out different cohorts is what they're called. We have 1 to 5 people come in, they all split it equally. And they get roles, and we train them in each discipline. So legal, finance, operations, marketing, we try to give everyone a role to be able to understand. We have singles, we have 5. It really comes down to who you're grouped with. And, it's kind of a shot in the dark. We lucked out. Josh, who's on the line, is in one of the cohorts, and, they get along great and they're pushing forward. And it's that time commitment. We say 5 to 10 hours a week to start. They probably put in 10 to 20. And, what you put in is what you get out. The new kind of way we're running it is we're teaching you every aspect. So there is a management company involved. There's a GP involved because you're raising outside capital. Our model isn't exactly great for regular fund of funds. If you guys had a question, you can reach out to me and I can get you a little more towards that area. But for the fund school, we go through the management company, which is kind of where we process everything. And that's where the management fee comes into. That's where we pay expenses. And that's how we handle the GP equity. So why have a GP? Your general partner is the one who makes all decisions. So they take the risk, they get the carry. So normally real estate is somewhere between a 70-30 split to an 80-20 split between the limited partners, which would be you guys, and depending on how you want the structure or anything, would be between the LPs and the GP. And that's where the GP kind of sits separately from the management company, where they only get the carry. We go through that process. It's taken a little longer this time than we expected. We're looking at probably 3 to 6 weeks turnaround time going forward, where we've worked with one, actually Thompson Hine is the lawyer that we've been using. And once we get you to the point where the management company is set up and you can raise capital once everything's signed off on, we get you in front of different broker dealers. You guys, and so me and Jeff are the training wheels. We are not making the decisions for you guys. We want to give you the options you have, but you guys are going to come down and make the decisions yourself. Once you kind of get everything set up and you're ready to go out and the deals start coming in, you'll see the deal flow, you'll see investors come across. You still have to pitch the investors, and that's kind of why I say, and if anybody's seen my post a couple times this week, effort matters. You're going to still have to sell yourself at the end of this. What the stories are, of course, is you're taking part in the fund school. you're learning this, you're learning that, come support us because you're emerging managers at that point. If you're handling it by yourself, there's really no need for that. You've already had your capital. You can just go out and start structuring deals. And then kind of my favorite part, at least, of the process is once you start dispersing capital to these different transactions, you get to handle all the internal transactions. We have outsourced fund admins because fund administration is huge, especially in the space, that we have an independent view of what's happening to your capital. Because if you invest in UC, I think, what's his name? The guy who went to jail, was it Bernie Madoff? He sent you a statement from himself and it said you kept going up 10 to 15%. What we do is we partner with a couple of fund admins, probably ESFI going forward. You have an independent accountant looking at your books and records. You deal with them on a monthly basis. They take care of everything, including cash movements. And eventually they're going to have their own portals as well, where, all you have to do is kind of make the decisions going forward. You'll see, the different calculations behind it. And, you get to make those decisions. Our goal is to 4X the funds in 10 years. So we have certain votes in place where at the end of 5 years, you decide to either take a distribution or reinvest. At the end of 10 years, if you reinvest, you can make, we turn 10 million into 40 million. And then you kind of do the breakdown yourself for the 20%, depending on how many people you brought in as a GP. You divide it 5 ways, you divide it one way, whatever way it is, and you can see what you can make. We've set them up to be evergreen, basically. So I know someone posted, actually may have been Don at some point, I can't remember. Someone today posted something about evergreen funds, and that's what we set up. So you can grow it as much as you want. If you think about it, at the end of year 6, if you make your money back and you pay off all your investors, what's the positive? They're playing with house money. Do they really want their money back at that point, or do you keep growing? And that's the gist of what the fund school actually is we want you guys to learn it at a micro level. So the next one you go out to do, you can raise 50 or 100 million, especially if you raise 10, 50 and 100, it's actually easier to raise more money.
Yeah. Well, great info, Ryan. I guess, some thoughts we have now as we're talking about building this fund and operating it and raising capital and the scaling potential in it is once we've raised the capital, we've got this thing running, obviously we're hopefully going to keep this going perpetually, obviously, because the evergreen fund, we're going to keep raising and finding more deals. But what's our obligation to the money we've already raised, those investors that are already in? What does that commitment look like?
It really comes down to the structure overall, but there's always a way to start a new fund. And I think that's kind of the easier way, especially when you get into private equity, venture capital, or real estate, because you're locked up for a specific period of time, whether you're going to hold it for 5 or 10 years, it is extremely hard. So our concept of evergreen is once you get your base in, you're locked in. You might be able to trade on the secondary market to get out. That's the advanced class. But what you want to do is you want to make it as simple as possible for everyone. And if you say you started with 10 million, in 2 years in, you wanted to raise another 10 million, the logistics behind it and the accounting behind it, it doesn't lead to the flow anymore. I could show you complex calculations that would probably put everyone to sleep, but the goal is to be as straightforward with your investors as you want. Would I say raise $5-10 million funds? Probably not, because at some point, certain people get into certain deals and certain people get held out, and you want to be as equitable as possible. And especially if you start your own management company, your own GP, and you're creating all these funds, you either want to change the focus to something slightly different, then people could put their capital that they used in the original fund into something new. You don't kind of want to raise parallel funds, because again, you can, and then it goes through deal flow and structure, things like that. But if one of your funds is Happy Camper Capital And that's all well and good. The next one should be maybe multifamily or something like that. You don't want to go into a similar space because your responsibility to your investors is basically treat them all equal. So you want to either change the focus or figure out a way to kind of encompass it all into one, but I would recommend against that at any time.
Yeah. Awesome, Ryan. Any other information you had to share before we start diving into questions?
I mean, if you were getting into something smaller, and it's not to pitch my personal side of the consulting firm, but you know, it is a lot cheaper if you're doing friends and family. You're not going to go on and create these massive funds. And you know, I think anybody at this point tells you it's exciting when you do it with a group. It's exciting as you get through the steps. But if you really are just focused on a small group of capital, friends and family, something like that, always get a consultant, because even though you're friends and family, I think we all have at least one family member we don't get along with. And if you bring them in, you know, it could just spoil everything. So you still want the legal, you still want some type of allocation, accounting, operations kind of manager to oversee everything. So always have someone look at it, because, you know, as much as you can trust your Uncle Ed who lives in South Jersey and drinks every day. Oh wait, that went too personal. But like you can't give him, you know, you don't want him to have control over the money because you know it's gone.
Sure. And if anything, that's probably good for relationship preservation anyhow, to have that structure in place. So,
yep, because then you could just blame the lawyers.
Right. Okay, perfect. Well, Ryan, I appreciate the presentation thus far. Obviously, I want to leave plenty of time for questions. We got a few in the chat, and I bet we've got a few more brewing in the room. So I'm going to start in the chat. And the first one I've got is, under what conditions would you need to be an RIA to run a fund of funds? So registered investment advisor, what conditions do you need to be one?
It's over. I can follow up with the group later. I'm trying to think of the exact. There's an amount. There is an amount. If you raise too much, you would. The 10 million range that we're in, you know, you don't have to. It really depends on what you want to do. I want to say it's somewhere between 50 and 100 million. There is an exemption, and I think the exemption works for a lot of long-term deals, like real estate and stuff like that. Like if you were getting into the stock market, I know that one's pretty specific, because they want to make sure that you guys, you know, you guys are on top of your money, and you're on top of all the registrations and things like that.
The next question we got here, this is a good one. I've heard this one a few times. It's similar to Seth's question. I have some team offering a GP stake if I can raise money for their projects, but I understand there are rules around raising money as a third party. Are those rules the same if you have a fund?
They're similar, and it does come down to what offering you are. I mean, at least for, what is it, the 506B? 506B, I believe you have to be a related party. You can't just generally go out and be like, hey, who wants to invest in this fund? Once you do that, you're in trouble. I think it's the 506C. You can advertise, but only to accredited investors. It makes it they make it incredibly difficult to raise capital. I mean, you'll see a bunch of, I mean, I've been following you for about 2 months now, maybe 3 months. You never see the stuff you see with some of these solo guys who are, I think it's, I'm not going to name any names because I don't know the details behind the scenes, but you see those guys who are like, this is the deal over here. And then they'll be like, sign up here for below. Well, technically, if they sign up for more information, you build the relationship and you technically become a friend and family. So there's many workarounds and there's many ways, but you don't want to be caught with that. You know, the SEC and FINRA and all that frown upon all of that stuff. And it really comes down to, again, risk tolerance. I mean, I don't have it. You know, one of my jobs is compliance and finance at FoF Capital. And they have 3 different offerings. One is a Reg A, which goes out to individual investor or any investor. You don't have to be accredited. And the other 2 are debt and syndication. So each one is to a different degree. One is a 506B, One is a 506C, and the other one is Reg A, which means I can go out. I can literally post a link right here if I wanted to about investing in real estate, and you guys can sign up. But if you see the 506 C, it's private. So technically, Reg A people can't see that. So it gets very difficult when you have multiple different offerings out there. But there, it's always, I think it's cover your ass is the greatest concept that was ever built for it.
Yeah. Now Reg D is going to be our most common. I think the Reg A structure, the mini IPO, is a great structure, but there's a lot of heavy setup costs in that. So would you agree, Ryan, that that's generally if you're going after a really massive fund?
Well, it has two limits. It has a $20 million limit and a $75 million limit. It takes about 6 months and $100,000 to $150,000 to launch. So it's very expensive. I've talked to a lot of them because we created one, but it's not generally used for a fund because of, the micro shares that you have. There's different limits. So Veloce Capital has a $5,000 limit. We're pitching that to accredited investors because we know they can afford it. With the non-accredited aspect, and I've talked to a few service providers and Reg A experts, your goal is 15 to 1800 per share at a max, because that's about what liquid capital is for those people.
Okay. Just moving on, we've had a couple requests for a portal. And actually, Jared, if you're in the room, if you could unmute, you got a couple of statements you made. I'd just like to address you. You asked about a link to a portal, but then you also mentioned steps in a workflow. Do you mind asking your question out loud?
Sure. Yeah, I just heard that Ryan mentioned a name of a portal site. Like I'm aware of a Sure, it creates indications and stuff.
Mm-hmm.
I heard you mention some websites. I wonder what it was.
So we're gonna probably eventually go towards Wealth Block, and from my perspective, from the accounting and operations background and the flow that we've kind of carved out for the fund school, that's eventually going to be the easiest for us to adapt to. There are a dime a dozen at this point. It's kind of scary at times. They have the private ones like Appfolio and Yardi, and there's one other one, Juniper Square. Those are more on the private side where you bring investors in. I don't know how many I've been pitched to in the past 3 months with the fund school, but it's probably about 20 of them, and they're a dime a dozen. They claim to be fund admin, they claim to be legal, but really they're just kind of shells, and some of them work out. The top two that I know of is Dealmaker and Wealth Block. I think they're both solid options. And the problem that I see, especially coming from my background, is I like fund administration. I don't trust them, but that independent view is what you need, especially when you have outside investors. And if you can find one that you can trust, that you can work with and then review, it works out, it works wonders.
So you mentioned Dealmaker and Wealth Block. Is that what you said?
Yes.
And Jared, your last comment on there mentioned steps in a workflow timeline. Can you elaborate?
Yeah, you mentioned 506B and 506C and the different, like, I don't know, what do you call it, shells or structure around it. Just the timeline on when you could actually mention something to someone without stepping on the SEC's toes.
When you're raising capital, it's once the 506B or C is filed. It has to be filed along with the Blue Sky within 15 days of your first raise. So it's kind of like you have to be kind of ready to go, and the lawyer will file it almost simultaneously. Again, it depends on who you can go out to. Like friends and family, you can talk to them tomorrow if you're going to raise. It's not a problem. Friends, even your connections on LinkedIn, if you can show some sort of relationship, even a couple comments on there, like you've talked to them for 3 months, there's a
paper trail.
Yeah, it's only tough when they come after you. Like I have a friend who's a registered investment advisor. He wants to talk to my boss about a project, and I had to get him to fill out all this documentation to say that we knew each other for 2 years before he came in. So it's really in the details and what you've actually structured for it to all figure out. In general, you try to create as much buzz as you can without offering it. You'd be like, listen, I'm thinking of starting this fund. I mean, it's not exactly, you can't go out and say, give me your information, I've got an investment for you, but you can do anything else.
Is there any particular relationship management system that you use to track who you've known for how long and what you talked about? If it's not somebody you are intimately aware of.
I mean, I've used Monday.com, which is basically not that. It's not really a CRM and all this other stuff. Appfolio I've used. Juniper Square is horrible. I would never use it, but hey, you can make that decision on your own. It's also really expensive. There's a lot, like WealthBlock has one, and Dealmaker both do. And they can even, once you get up and running, and if you do a 506B, or I'm sorry, 506C, you can actually put a lot of that information in there and they'll blast your investors. So there's definitely some positives and negatives. I will tell you this, if anybody offers you fund administration, it's probably a scam, or to some level so light that it's actually not useful. And that's coming from an accountant. That's not, even WealthBlock, I love them, but we still have a fund administrator going through them because you need that extra level. There's a whole nother, I mean, I can go into fund administration for hours. There's different levels of compliance that they actually go for to prove that they're independent.
So are you almost saying that you'd want to see some kind of insurance policy, kind of like when certain bank accounts, FDIC insured, like you want some kind of assurance that if something goes wrong, they have you covered?
Yeah, and you want to make sure that you have it too. Like the management company usually gets insurance to some extent to cover at least the liability behind, the things that could go wrong. You don't want to get insurance on your whole, $10 million fund because it's expensive and kind of useless because it's written in the documents that you can lose money. So, you can't lose more than you invest, and that's kind of the limited liability in the partnership, which kind of protects yourself.
Okay.
Ryan, that actually brings up a good question on my end here. Just when we're talking about getting this started, what's the advice you give on errors and omissions or director and operators insurance?
I mean, for you guys, yes. It depends on. I mean, again, it comes down to risk and appetite. I mean, if it costs a couple $1,000, it's not a problem. If they want $100,000 for a policy, that's just kind of a waste. And it comes down to what you have in place. If you have it's called SOC 1 administrator, you have some sort of compliance in there that gives you an extra set of comfort. Hedge funds, if you're trading liquid securities, you really don't need it. If you start getting into private placements, stuff like that, you'll want it. So it really depends on what your infrastructure is and what you're investing in.
Right. Okay, perfect. Any other questions we had in the room?
Yeah, we did have one earlier too that just guess clarification on terms. Is it called a fund of funds or a fund to funds?
Fund of funds.
All right, thank you.
So if we had any other questions in the room, that'd be a great time. We can come off mute and air those while they're still fresh on your mind and while we got experts in the room. All right. Well, I'm going to say if there aren't any other questions, Ryan's going to share some information on how you can get in touch with the fund school. Of course, I always recommend, make sure that you check with your legal team. Nothing we're giving on you here today is construed as legal advice or investment advice. You need to consult with your own advisors on this, your own experts. Don's smiling. I've given this disclaimer at every one of our webinars. But just make sure you're consulting with the right people, interviewing the right people ahead of time, educating yourself. I strongly recommend that you get into this space because your investors will hopefully be doing their diligence on you. Brian Burke's book, The Hands-Off Investor, is a fantastic read. We should all, if we're getting in this space, ingratiate ourselves in that, know the things that our investors should be looking for so that we can put our best foot forward and keep our name in this industry untarnished. So Ryan, I'll turn it over to you if you want to share a little information about the fund school and how someone can get in touch with you.
So, I mean, LinkedIn is probably the easiest way between myself and Jeff McDermott. If you want to look up both of us and follow us, you'll find out a lot. The Fund School is on LinkedIn. We don't have a website yet, but we do have Typeform for people who want to try out the Fund School. And I can post that. I think actually Josh put it in there. If you go to thefundschool.com, it will take you to the Typeform and tell you about what we offer. Outside of that, you know, if you guys have any questions or anything, I appreciate your time. You can reach out to me anyway, besides texting. That my headphone will just, I try to keep it a little bit separate, but, you know, reach out to me on LinkedIn if you have any questions, if you read the books, if there's any questions you have, just use me as a resource. I'm happy to help.
Okay. And of course, if any of you are aspiring to put capital together for deals and maybe you've already started, or maybe you're heading down this road now, we at Happy Camper Capital, we specialize in outdoor hospitality investments, namely RV resorts, campgrounds, and marinas. We'd love to talk to you about future partnerships. We're open to several different ways of partnering with other capital raisers. Of course, if you haven't been in our investor portal yet, you can visit investors.happycampercapital.com. We'll be able to chat with you and get you in so you can see what kind of deals we have and see if that might be something that would fit in with your appetite. I see one last question that came in from Kathy, which is, who is the Fund School co-founder? And that would be Jeff McDermott, who is Ryan's partner. Perfect. Ryan already nailed it.
He wanted to make it today, but he couldn't. He got double booked. But yeah, you can reach either one of us if you have any questions. Fill out the form. I mean, it gives you all the details, but you know, it's a lot to list out. It's almost like 2 pages worth of information, or else I'd read it to you guys. But the details are there.
All right.
I did have one question before closing up.
Yeah.
There's a lot of programs out there where it's almost like they kind of certify you in a way, or they know that you're in some kind of program that's, because it requires a lot of education with a lot of the stuff. And maybe like it says, yeah, this person has reviewed enough information, they're sophisticated enough to make decisions on their own, or they're aware of the relationships. Is that anything, or?
So no, the long story short is you're getting hands-on experience. You're going to be able to do everything. The short of it is you can take all these courses online and you can get a degree. I mean, I can't remember half the names, but they send you books and, you know, you can create an SPV. What we do is we offer live teaching. The money does not come to us. It goes right to the management company. We make sure that you guys learn. Of course, we get paid off of, you know, a percentage of the GP and a percentage of the management co. But, you know, outside of that, we want to make sure that you guys get a full experience. It has nothing to do with, you know, like a tuition or anything like that. You know, we want to make sure that you guys learn. We move at your speed. We want you guys to succeed because we all succeed. And as much as I've seen the books and I've read them, you know, how to start a hedge fund. And when I started back in 2006, I bought 4 different books. And they all teach you the same thing, but what they don't give you is that hands-on experience. And if you have skin in the game like that, if you put money in, you tend to put more effort forward.
Yeah, Ryan, I think I can echo on that, you know, you can have all the tools and systems in the world, but at some point you need the experience and need a good mentor.
Yes.
Fair enough?
Yep.
Yeah. Well, we'll close it with one final question that came in. I want to be respectful of everyone's time tonight. Which says, if I sign up for the Fund School, what types of investments can I expect to be investing in besides Happy Camper Capital? Maybe it did that last part.
No, nothing other than Happy Camper Capital. If you come in from this, you're 100% into one deal. So currently we have 2 kind of streams. One is going to be real estate, which is ground up real estate in multifamilies. And the second one is venture capital. Venture capital is kind of, it's a little more advanced. We're going to have this person pick a segment to be in, just because I think everyone agree you need a focus. You know, why we're doing multifamily equity early stages is because it's straightforward. They need $3 million in 18 months to 3 years. They need to be out. You'll get an IRR somewhere around 29%, something like that. You know, where we're not worrying about rent rolls. We're not worried about, you know, taking in capital on a monthly basis. We're trying to avoid that because we want you guys to get the learning experience. If the next one you want to invest into real properties and worry about rent and income and stuff like that and getting monthly distributions, you know, it's something down the line. We're trying to give you the easiest way to learn hands-on without getting too complicated.
Okay. Right on, Ryan. Well, thank you so much for your time tonight. Absolutely grateful for you. Obviously, as Ryan shared, you can go check out, you can fill out his type form at thefunschool.com. That information is in the chat if you want to copy that. This is the first of many to come in the Happy Camper University educational series. We're committing to, at least for now, the first Thursday of every month to bring you a new topic, something that will help you build wealth or expand your knowledge. So keep posted. If you like this, let us know. Let us know what we can bring you. We want to give you things that are going to provide immense value. So thank you to everybody for coming out tonight. Thank you, Ryan, for joining us.
Thank you, Adam.
All right. Have a good evening, everyone.
Thank you, everybody.